Hey everyone, the retail sales numbers for May just came in and they went down a little bit on a month-to-month basis, but they're still up by a massive 18% compared to pre-pandemic levels, and sales will likely get a boost through the summer. California just reopened, canceling most of their capacity limits, physical distancing, and mask requirements. Washington State will reopen at the end of June, and Michigan will reopen on July 1st. Hawaii, New Mexico, New York, and Oregon look like they will also fully reopen very soon, bringing the entire country back to business. That will give the economy a major boost. In May, restaurant sales once again surpassed grocery sales, a major milestone. All the more so because grocery sales are up 13% above pre-pandemic levels, and all retail sectors are above their pre-pandemic level. Sporting goods are up 42%, internet sales are up 34%, and building materials are up 21%. Restaurant sales just cleared the hurdle, now up 1.6% from February of last year. But there are some headwinds. There are some shortages due to supply chain logjams at the ports, on rail, and by truck. Moving products to retailers has slowed in the wake of the pandemic. Even more pressing are labor shortages, which are forcing some restaurants, hotels, and retailers to operate without full staff levels. This is also driving wage pressure and inflation. The $5.5 trillion stimulus is still driving ripples through the economy, and the money supply is 26% above pre-pandemic levels, so liquidity is elevated. For real estate, this brings good news, and for some not so good news, depending on their perspective. The good news is that investment real estate tends to be a good inflation hedge. As costs rise, real estate rents and values tend to mark to market. Higher building costs tend to raise property values as it slows construction and raises the replacement costs for buildings. At the same time, revenues at the properties rise as leases and rents are adjusted to market rates. In addition, elevated liquidity makes it easier to borrow, and interest rates are still exceptionally low. As a result, right now, there is tremendous commercial real estate market liquidity and interest rates are low. The 10-year Treasury has been range-bound around 1.5% to 1.6% since March, about where they were at the beginning of the pandemic. The not so good news is, again, a matter of perspective. The market liquidity, low interest rates, and inflation resistance is bringing more money into commercial real estate. That, in turn, is driving up property values. Not all property types, but many, particularly the ones that fared best through the pandemic, like industrial, apartment, and self-storage. For investors trying to buy properties, that often makes for an aggressive bid climate. That in turn is driving up prices and putting downward pressure on cap rates. On the other side of the coin, investors considering the sale of an asset, whether to take some chips off the table or to do a sale leaseback or to reposition into another property type or market, now have a unique opportunity. Investors considering selling have the wind at their back right now, as there are more buyers than sellers. That means sellers may have a unique window of opportunity to capitalize on the wave of capital coming into the sector. But this will likely be a limited window. The markets will recalibrate over time, and the rising inflation pressure could force interest rates upward. Hopefully, you'll have the opportunity to capitalize on what I believe will be a relatively short-term window of opportunity. Then, as things move back to normal, you can once again focus your eyes on the horizon.